Now, for more on this, we're joined today by Professor Oh Joon-seok, Dean at the College of Economics and Business at Sookmyung Women's University. Professor Oh, thanks for coming on today.
Thank you for having me.
So, global oil prices fell after the United States and Iran announced a ceasefire deal, but many energy experts say it could take months before oil and gas supplies return to normal. Why is this, and does this mean consumers will have to wait longer before actually seeing lower oil prices and costs for food and other goods?
High oil and gasoline prices are energy supply problems won't be solved overnight. It will be likely take months before energy companies can restore its operations to the level of the normalcy. Ships loaded with crude oil have been stranded in the Persian Gulf for more than 3 months, through which about 1/5 of the world's oil and gasoline supply typically traveled before the war began. The slow pace of shipping and refining crude oil and doubts about the security of traveling through the strait imply the effect won't be seen immediately. In addition, most physical oil and gas volumes are traded on long-term forward contracts, which means signed months in advance. In this way, consumers must wait longer because businesses are currently selling inventory produced and stored in older, more expensive energy. As fertilizer, a byproduct of oil, has already in cost, putting pressure on farmers. Global food prices could also be helped if the supplies of fertilizer get closer to the normal level again. And jet fuel, another byproduct of oil traded in Northwest Europe, has already seen a small fall in prices. Next wave will be a monetary contraction. The Iran war has affected economies around the world as the jump in energy cost has pushed up fuel prices, leading to a pickup in inflation. This has pressure on central banks in most countries to raise interest rates with tightening monetary policy to keep inflation under control.
I see. And the U.S. dollar also weakened against major currencies after the ceasefire was announced. Could this also pave the way for the Korean won to strengthen against the dollar and potentially move below the 1,500 won level? And what risks could still keep exchange rate volatility elevated?
Yes, as you mentioned, the U.S. dollar index measuring the greenback against a basket of currencies, including the euro, yen, and pound, has shown near multi-year lows. As for Korean won, in spite of a continued increase in export and investment, sparked by a strong performance of the semiconductor and IT sectors especially, contrary to the weakening trend of the U.S. dollar, the $1 exchange rate continues to above 1,500 ranges. This might be mainly due to safe haven demand and corporate dollar holding under the high exposure to global uncertainty. And the U.S. Iran framework agreement to restore passage through the Strait of Hormuz could probably cool the global panic of buying dollars as time goes. However, as I experienced when I was at practice in the period of financial crisis, at this time, most dealers fearing consecutive extreme fluctuations, then believing that dollar is the king. And so the Korean export firms are refusing to convert their dollar earnings back into one, starving at the local foreign exchange market of supply. So, accordingly, regulatory intervention and crackdown follows as usual. Bank of Korea and Financial Supervisory Board, they recently launched their joint inspection of foreign exchange banks to root out speculative trading, so-called artificial dollar holding. Despite the positive momentum of Korean economy, private sector is counting on another risk factor, which will not be changed easily. That is capital outflow. Continued trend of this kind of market, diversification by individual retail traders and national pension services create a permanent and structural demand for dollar. That is the weakest point of working against won appreciation. It could have been worse. Korea's economy will likely grow at a sharper than expected pace of 2.5% this year, thanks to strong export.
And the U.S. Federal Reserve is set to make its policy decision later this week. And with the ceasefire now in place, many analysts believe the Fed is less likely to raise rates. Why has this outlook shifted, and what implications could this have for monetary policy in other major economies?
Yes, U.S. Federal Reserve is less likely to raise rate because the ceasefire reduced the threat of energy-related stagflation. The U.S. Federal Reserve is expected to hold its benchmark interest rate steady at 3.5% to 3.75% range. Why has the outlook shifted? Global factors such as commodity price and equity markets were the primary driver of foreign exchange movement earlier this year. More recently, domestic factors in the United States, including the interest rate differentials, have begun to play a larger role in determining currency performance. Prior to the ceasefire, surging we know that West Texas Intermediate crude price had pushed the Fed officials to actively consider rate hikes. The reopening of the Strait of Hormuz to diffuse a major supply side shock. What implications could we have? Hikes are highly effective against the demand-driven inflation, but raising rates into geopolitical risk will be likely to induce a severe recession as a result. When the Fed raises rates, it constantly triggers capital flight and depreciate emerging markets and the European currencies on and on over big waves follows. Thus, in short, at this moment, a steady Fed rate will be an answer to calm down volatility and then reduce downward pressure on these currencies. Global easing imported inflation concerns.
I see. All right, Professor, I'm afraid that's all the time we have for today. Thank you so much for your insight today. We appreciate it.
Thank you for inviting me.